So hello everyone. I want to thank you for always watching our videos. Those who have subscribed, I want to thank you, and I want to empower you to share our videos to few clicks such that we can understand accounting together. So today we want to look at International Accounting Standard 16 PPE, for the one we refer to as property, plant and equipment. Property, plant and equipment. IAS 16. IAS 16 covers all aspects of accounting for property, plant and equipment. So when we say property, we mean land and buildings. Plant and equipment, we mean all types of machines. All types of machines, all types of motor vehicles, and all other equipments that are used in the production of goods, in a supply of goods, or they are held for rental to others, but also for administrative purposes. So those are items of PPE. So when we are accounting for them, we use International Accounting Standard 16. Now, here we are going to look at accounting for tangible non-current assets. Tangible fixed assets. Assets that you can touch. So by definition, in earlier videos, an asset is an economic resource controlled by an entity from which an entity expects to generate cash flows. So an economic resource controlled. The important words that we must note, the word control means that the company or the entity has the right to use the asset, has the right to the cash flows generated by the asset, but also that the asset has the capacity to make decisions over the use of the asset. So in this case, some books will tell you that it is an economic resource owned by an entity, but really that is practically wrong, because an entity can lease an asset. It has the right to use the asset from IFRS 16. So if we say own, now we are limiting our coverage to ownership only, yet an entity can control an asset when it is not its legal owner. So here we are going to look at accounting for tangible non-current assets. Accounting for tangible non-current assets. So we are going to look at the scope, and of course we must note that IAS 15 should be followed when accounting for tangible non-current assets, and there are instances where it shouldn't apply, especially to biological assets related to agricultural activities. Biological assets are accounted for using IAS 41, accounting for agricultural products. 2. Mineral rights and mineral reserves such as oil. These are accounted for using IFRS 6, exploration, and exploitation of mineral resources. So now any non-current asset that is related to biological assets or agricultural activities or that is related to mineral exploration and exploitation will be accounted for using respective international accounting standards, but not international accounting standard 16. That is clear. In the scope of IS 16, biological assets and the mineral rights as well as mineral reserves such as oil, gas and other non-renewable resources, they are not accounted for or they are not in the scope of IS 16. So for every standard, as we agreed earlier, there are some things we must note. One is the recognition. The day a transaction happens that involves the acquisition of a non-current asset, what happens? What we call the initial recognition. Another aspect too is the measurement. After an asset has been acquired, what happens after a certain period of time when an asset is being used? Then what follows is reporting. How do you report an asset in the financial statements? If it's time for reporting, how does the asset appear in the financial statements? Then, for disclosure requirements, what must be disclosed on the face of the financial statements and what should be disclosed in the additional information or the notes to the accounts? Now, there are some aspects that we shall look at under IS 16 that are contrary to what we look at using other standards. In here, in IS 16, we shall look at disposals. In instances where you bought an asset, let's assume you bought a motor vehicle, and after some time, let's assume after 4 years, you choose to sell it. What happens, or how do you account for that disposal of a motor vehicle? However, disposal means a lot in accounting. An asset, for example, a motor vehicle can crash in an accident. If an asset crashes in an accident, that one is deemed as disposal. We look at the scrap value, the remains, and then we compare with the carrying amount at the time of an accident. We shall look at all those issues, but also we shall look at the subsequent measurement where we shall be looking at the models that must be adopted by an entity when it wants to practically measure the non-current assets. So let us just start with recognition or the initial recognition. This standard requires an entity initially recognize property, plant and equipment at its cost or at the cost. But before you go into that, let us first understand the meaning of recognition. It refers to the incorporation of an item in the books or in the business accounts. Incorporating or recording transaction relating to the acquisition of a non-current asset in the books of accounts. By doing that, we are initially recognizing a non-current asset. Now, there are conditions that an asset should meet before qualifying for recognition. One, that there must be a probability that the future economic benefits with the asset will flow to the entity. Uh, maybe this one. Home. Hmm? From the asset we will accrue two. Two, that the cost of the asset can be measured reliably. So if we can measure measurement concepts, if you remember the accounting concepts, we have monetary concept. If we can ascertain the cost of the asset, therefore this asset qualifies to be recognized in the business accounts or in the business or in the entity's accounts. So initially, the standard requires an entity to recognize an asset or a non-current asset at cost. The question is, what is the cost or what are the components of cost? The cost of an asset includes the purchase price. The purchase price, let's assume maybe a motor vehicle in Japan is 50 million. That is the purchase cost. If there is any discount, rest it from the purchase cost. Two, the cost also includes the import duty. Here we mean the taxes to import. For you to get this motor vehicle from Japan, you must pay import duties, the taxes on importation. That also is part of the cost of the asset. Because if you are not buying this asset, this motor vehicle from Japan, you wouldn't pay these taxes. Therefore, these taxes must be added back to the purchase price to make the cost of this asset. Three, direct costs. Maybe for you to get this motor vehicle, depending on where you are, maybe you had a driver to drive it from the port to the seaport to the factory. Or maybe there are some other costs like you need to maybe to paint it, you need maybe to do some repairs before you use it. All of those are direct costs that intend to put an asset to its working conditions. Or maybe it is a machine, and for the machine to start working, you need to first clear maybe somewhat a certain area, and or else you need to install that machine. All of those are direct costs that are attributable for bringing the asset to working conditions of its intended use. Therefore, they are part of the cost of the asset. Then another component is the initial estimate of the dismantling costs. Let's assume that maybe you are bringing a machine that is going to be used in a drilling of oil. At the end of, or at the expiry of oil, you need to rehabilitate the environment the way you found it. Therefore, dismantling costs are also part of the cost of the asset, if at all the asset obtained is of that scenario, of that caliber. So now, initially recognizing that cost means that you need to first get the cost of the asset, and then after you recognize it in the books of accounts. Now, we have a practical example here. They are telling us that on the 1st January 2023, Nakasa Uganda Limited acquired the plant under the following terms. That the quoted price of the plant was at 100 million. Import duty, those are taxes, at 5.4 million. Installation costs at 7 million. Carriage inwards, that is transport, 4.2 millions. Then there is reproduction testing at 4 millions. So, given this information, we are required to initially recognize the asset in the books of accounts. So, how do you start? Let us come here. We shall come here and start. The quoted price here is 100 millions. Let us work it out from here. 100 millions. On this, we add the import duty. The import duty is here. Add import duty here. That's 5.4 millions. 5.4 millions. Then on that we add the installation costs. Add the installation costs. Installation costs are 7 millions. 7 millions. Then on that one we add carriage inwards, that is transport. Transport is added here. Transport is 4.2 millions. Then on that we add for the production testing. Maybe this plant needed some testing, and the pre-production testing is at 4 million. Production testing is at 4 millions. Yeah. Four millions. So now we have all the components of the cost. So for us to get we now have to add all of this, and then we get the cost of the assets. Costs. Cost of the plant. Now, that is the cost of the plant. At how much? Can use the calculator here. 100 millions. This one becomes 105.4. Then we add 4.2 millions. So what you do, you get the total here. This becomes 9.8, then 13.8, 20, 120, 28 million. That one will be the cost of the products. Let me borrow it here such that we can get it right. Cost of the plant will be 120 millions. So now, as an accountant, what for us? Now, recognizing means what? We are going to debit. We are going to debit the price with 120 million. But also credit. Bank. Assuming we are paying by bank, we are going to credit the bank or cash, depending. With 120 millions, 0.8 millions. That is how we shall recognize the assets in the books of accounts initially. So we have recognized the asset or the plant in the books initially. Now, that is how we recognize an asset initially. Subsequently, the asset requires, the standard requires an entity to choose between either cost model or the valuation model. So there are two options that an entity could choose between either cost model or the valuation model. And the standard says that if the entity has chosen the cost model or valuation model, that should apply the method consistently. Now, when we talk of cost model, we are saying that if, for example, an asset has been used for a year or for 2 years, what follows? Because here initially we recognize that the cost. This is the amount of money they spent to get this plant. So after using now this plant for a year or 2 years or 3 years, what does this plant appear in the financial statements? Or how is it measured? Because me and you know that if an asset is being used in the production of goods or services, or in the supply of goods or services, or in administration purposes, it must lose value. Even if you are given a computer today and you use it for a year, and maybe you bought it at 2 millions, after 1 year, there is the most amount you can get is like 1 million because it lost the value by depreciation. So now we are going to be seeing how the asset that we bought at 120 millions is going to be appearing at the end of year 1, at the end of year 2, at the end of year 3, up to the end of its useful life. So the standard proposes two models, one being a cost model, and cost model means that you get the cost of the asset at the date of acquisition, you less accumulated depreciation and any impairment losses. So every entity will have its depreciation policy. It could be maybe that they have their policy that they depreciate their non-current assets using straight line method, or they are using reducing balance depending. We shall have a complete session about depreciation and methods, and we shall work out examples on how we depreciate assets using different methods. So here we are going to focus on profit model, whereby it says that get the cost minus accumulated depreciation. But also, a company can adopt the revaluation model. And by definition, the revaluation means the fair value at the date of revaluation less accumulated depreciation and impairment losses. And me and you know that fair value is the selling price minus cost to sell. So you look at an item. If I was to sell it, how much would I get from it? And therefore revalue it at its fair value. But the standard says that the valuation model must be used if the fair value of an asset or an item can be measured reliably. So if you are unable to get the selling price less cost to sell, or what we refer to as fair value, then it is advisable not to adopt a valuation model because you won't get reliable estimates of the value of the asset. So that is subsequent measurement. Earlier I had noted about disposal. In case during the useful life of the years or the useful life of the asset, there happens a disposal. What happens? If there is a disposal of the asset, time has come and you want to sell it, yet it still has value, or its useful life is still pending. What happens is that you have to recognize the asset from the books of accounts. Now, what you do, you look at the disposal proceeds. How much are you getting from the sale of this asset? Then you compare with the net book value at the time of disposal. In that case, you'll get either a gain on disposal if the disposal proceeds are higher than the net book value at the date of disposal. If the disposal proceeds are higher, or if what you're getting from the sale of the asset, if the figure is higher than the net book value of the asset at the date of disposal, then you have a gain on disposal. But if the disposal proceeds are lower than the net book value or the carrying amount at the date of disposal, then it means you have a loss on disposal. And if that is the case, a loss on disposal is an expense and therefore it must be recognized in the income statement as an expense. But if it is a gain on disposal, a gain on disposal is recorded in the income statement under other incomes. So we must note those two things. Incomes, gain on disposal is reported under other incomes. Immediately after reporting the gross profit, you can report other incomes and say gain on disposal. Then after you can report contract revenue, you can report other incomes, discounts, something like that. So now rose automatically for it depending on the policy. It could be charged maybe to admin expenses, it could be charged anywhere, but you can also present it as an independent line item in the income statement or in the statement of financial performance. So that is how we treat disclosures. Now, let us look at the disclosure requirements. What are you supposed to disclose in the case of the financial statements? One, you disclose the measurement base for determining the gross carrying amount. How did you arrive at the net book values? Goes in the balance sheet, the non-current assets must appear at their net book values or carrying amounts. So how did you arrive at those net book values? You now need to disclose the measurement basis. Two is depreciation methods, the rates, but also the useful life of the assets. You need to state clearly that you use this method of depreciation and on which type, on which rate, but also if, for example, you're depreciating using straight line, you can tell the useful lives of the assets and a review. But also the carrying amount and accumulated depreciation at the start of the period. So now, before you depreciate an asset for a certain reporting period, you need to also say that at the beginning of the period, this was the carrying amount and the accumulated depreciation in the disclosures. But also the recoverable amounts of property, plant and equipment. So that one must also be disclosed. Then you also need to disclose the accounting policy for the estimated costs of restoring the site. We talked about the dismantling costs or restoration costs, and those ones, the accounting is quite different because now if you are accounting for those, you have to discount them because those are incurred at the end of the period. But also, you need to disclose the carrying amount of temporary idle items. Idle items, especially property, plant, and equipment. So now, those are the disclosures. Let us briefly discuss a practical example here. You see how it works. Now we have an example here. Now they are telling us that Pakasa Uganda Limited purchased the heavy truck on 1st January 2021 at 180 millions with estimated useful life of 10 years. The estimated scrap value of the asset at the end of its useful life is 15 millions. Advise. We are required to advise Pakasa Uganda Limited on the accounting treatment of the above transaction for their ended 31st December 2023. So there are key things we need to note here. They bought a heavy truck on 1st January 2021. Let us note that at the cost of 180 millions. This is also important to note. But also, the estimated useful life 10 years. This information is also very important. Then, as and they are telling us that the useful life at the end of it, the scrap value, and at the end of its useful life is 15 millions, or what we call salvage. Some books have it as residual value. So the asset was acquired on 1st January 2021 at 180 millions, and the estimated useful life is 10 years. The estimated scrap value of the asset at the end of its useful life is 15 years. We are required to advise the company on the accounting treatment of the above transaction for their ended 31st December 2023. So we need to first understand from the day the asset was acquired, 1st January 2021, to the reporting date, 31st December 2023. We need to first understand the number of years in between those two periods. So 2021, 31st December, that is 1 year, because the year that starts on 1st January ends on 31st December. We need first agree on that. So 31st December 2021, that is 1 year. 31st December 2022, those are 2 years. 31st December 2023, those are 3 years. Those are 3 years. Now, we are told the life is 10 years. Now, how do we now compute the net book value, but also the depreciation per annum? Because we have agreed that non-current assets are reported at their net book values. So how do we get the net book value? How do we get the net book value? Let us work it out from here. The cost is 180 millions. And we put it in a bigger font such that we can really get what we are talking about. Costs. Cost is 180 millions. But useful life is 10 years. Then we also have information about scrap value. Scrap is 15 millions. Then we can go back and see some other information given to us. We are given cost, we are given the useful life, and scrap. So depreciation, as me and you know, that depreciation is equal to cost minus scrap. Divided by, right? So you get the cost of the asset minus salvage or scrap. Everything divided by the useful life of the asset. That is the depreciation per annum. Let me indicate it here, per annum. So per year, that is how we get the depreciation. And now, that is how we get the depreciation. So now we are going to now to work it out here and say, therefore, depreciation will be cost, which is 180 million, then minus swap. Swap is 150 million, 15 millions, which will give us 165, then divided by 10, because this 5 is 10 years. So automatically depreciation per annum is going to be 16.5 million. If that is depreciation per annum, and remember, they are asking us to advise for their ended 31st December 2023. The net book value now will be the cost, which is 180 million, minus depreciation per annum, which is 16.5 million, but times the 3 years. If depreciation per annum is 16.5 million, then what is depreciation in 3 years? Depreciation for 3 years. So now that is how you work it out. So 16.5 times 3, you get using a calculator, of course, you get something like so we have 180, then minus 16.5, then times 3. What you get is 140.5. So that one would be the net total value at the end of the year. Now, how do you report? Because the question is saying that advise Kakasa Uganda Limited on the accounting treatment of the above transactions. So which figure goes to which financial statement? So here you can see we have the net book value at 140 millions. This is the figure. So every year we are reporting depreciation at 16.5 millions. Mhm. Here, let me paint it red. Red. Fancy. So now, the net book value, this equipment, this effort back is going to be recorded in the statement of financial position or in the balance sheet at its net book value of 140 millions. But also in the income statement, we are going to record the depreciation as an expense at 16.5 million because that is what we record as depreciation every year. Every year. And here, the asset is fully depreciated as scrap value of 15 millions. So that is how you advise reporting purposes, especially on the accounting treatment of this event track. So we have looked at different items of PPE today, but most importantly, what you do, you need to look at the initial recognition, make understanding both the meaning of PPE and the scope. Look at the initial recognition. And I told you that recognition means the incorporation of the asset in the books of accounts of an entity. Then, how would you record that? You first look at the cost of the asset. The components of the asset, you have looked at them. Those ones, of course, you need to total them up. If there is any discount, you receipt. Then after you get the cost of the asset, and recognizing means that you create the asset is account, you debit it, and then credit it. Either the payment mode, if it is by bank, straight to bank, you debit the asset is account. So that is how you initially recognize the asset. Subsequently, we have said that recognize or measure the asset by choosing between the cost model or the valuation model. And we have said that cost model means you get the cost minus accumulated depreciation to get the net book value. And that net book value is the figure that will appear now in the balance sheet or the statement of financial position. But also the depreciation charged at the end of the period must be recognized as an expense in the statement of financial performance. We have talked about disposals. You bought an asset, and this asset maybe you want to sell it at the end of the period. And be within the useful life of the asset. We have said that you compare the disposal proceeds with the net book value at the time of disposal. If the disposal proceeds are higher than the net book value, then recognize the gain on disposal. And the gain on disposal, we have said, it is recognized in the income statement and other incomes. So it is income. But if the disposal proceeds are lower than the net book value of the asset at the time of disposal, then it means get the difference. And that difference now will become a loss on disposal. And all losses are recorded as expenses in the statement of financial performance or the income statement as we or no. So those are disposals. Now, the valuation model says what? Let's recognize an asset at its fair value, less any accumulated depreciation and any impairment losses. Fair value means what? Selling price less cost to sell. Look at an asset and its market value. If we were to sell that asset, how much would you get from it? Then, but the standard says that revaluation model should be adopted by an entity only if the fair value can reliably be gotten or ascertained. Now, going forward, of course, we have even looked at the disclosure requirements, and we said that you disclose the methods or the measurement basis, but also disclose the carrying amounts, the depreciation rates, the depreciation policies, the depreciation methods, and also disclose the redundant property, plant, and equipment. So then now we can, I think, end here. We can end here. But if you find that this video or this tutorial is useful, kindly subscribe to our YouTube channel such that whenever we post another session, you are able to be notified and then you understand this concept together. Also share with your colleagues such that you can really get every bit of accounting on time. Thanks for being with us. May God bless you.